Hello and welcome back. Accounting 202. I'm your host, Dr. B. We are almost toward the end of the semester, if you can believe it. Today's December 1st. We just finished our Thanksgiving break. I hope that you all had a very safe and good Thanksgiving. The objective today is to cover chapters 23 and 24. I want to have a quick couple of housekeeping notes. By now, you should have completed all the work through chapter 22, which looks like just about all of you did. If you didn't, you probably received a few reminders from me. I want to preface that next week is our last week of content, which is chapters 25 and 26. Those are the last chapters of the book. And then you'll have your final exam will be the following week, right? So realistically, we're looking at about 3 weeks left. That's about right, because I believe the last day of the semester, I want to say, is like the 17th or 18th of December. So that's only 17 days from now. Is that right?
Yeah. The 17th is my birthday. Me and my sister's birthday.
Oh, fantastic. Okay. Well, that's an important date. So the final exam's on the 17th. So it's like 2.5 weeks from today. So there's that. What else can I tell you? We're rocking and rolling. So let's go ahead and continue forward. Today we'll do chapter 23 and 24.
Oh wait, Professor, before you begin, I have a question.
Yes, please, go ahead.
Our final administered? Is it like through Blackboard or?
Yeah, it's through Blackboard, just like all the other exams have been. Yeah, absolutely. Yep, pretty much everything's through Blackboard except for the Cengage homework assignments, which are, as you know, through Cengage. But you still have to access those through Blackboard. So everything you can find in the course content area in the classroom. And then just select the respective weeks within the modules. Good question. So thank you for asking. Okay, and just so you know, the final exam will cover the last 6 chapters of the course, and we'll talk more about that as we get closer. Okay, chapter 23, Evaluating Decentralized Operations. My first question I want to ask to the class, those of you who are here, what do you think the word decentralized means? Decentralized, what does that mean? To be decentralized. Any thoughts?
Is that like anything that's not in the office? Like if you had like a satellite location or something like that?
Yeah, kinda. That's you're on the right track with that. When we talk about decentralized, I want you to think about how.
It's like that certain organizations are controlled by certain local entities or something where you be decentralized, meaning if someone having control over your organization, say can I use an example like with Sasha Bruce with DHS, they're decentralized because DHS oversee their business. Is that something similar like that?
Yeah, absolutely. You're on the right track. So here's another way of thinking about it. At UDC, we have multiple campuses throughout the district. Our flagship campus, which is where the centralized operations are at Van Ness. Our decentralized operations are at 801 North Capitol. They're at Congress Heights. They're at the airport. They're at they're over on South Dakota. So we have at the Bertie Backus campus, we have multiple campuses, right? And within those campuses, we have departments. So the decentralization aspect, I want you to think about it from a department perspective within the organization. And I'll show you an example of that here in the chapter. Okay, so in a centralized company, all of the major planning comes from the top, the Van Ness, right? The president's office, yeah? In a centralized company, all of the decision making is at the top of the organization. In a decentralized organization, the decision making is made at the division or the department level by department managers. Okay, so for example, here at UDC, our program, our accounting program, is in with the business division that is within the community college that reports up to Van Ness. So another way of thinking about it is think of Macy's, the store, right? In Macy's, you have the men's department, women's department, kids department, jewelry department. All of those departments have department managers. Those department managers are responsible for their own budgets, for controlling their own structure, they're responsible for the products within their departments. Then they are the ones that make the decisions at the department level. They roll up to the central office, which is the store manager. But in a decentralized company, the department managers are the ones that make the responsibilities. They're the ones that are responsible. They're the ones responsible for making decisions. So again, the way to think about it, centralized means the president of the organization makes all the decisions, or the cabinet level, right? Decentralized, the individual departments make decisions. So that's the way of thinking about it. Advantages for having decentralized organization. For big companies, it's difficult for the top level management to make decisions because they don't see what happens on the front line day to day. So an advantage of having a decentralized operation is that the managers are able to maintain daily contact with operations on a day-to-day basis. We're able to have expertise at those levels. So, for example, in Macy's, the jewelry manager in the jewelry department is responsible for the jewelry product lines. They are an expert in jewelry. That's an advantage of having a decentralized operation. In these cases, delegating authority to the managers that are closest to the operations typically result in better decisions. For example, if I'm a manager of Macy's and I have a manager of the jewelry department that reports to me, I can say, hey, jewelry department manager, you make the best decisions for the products that you carry in your department. And that typically results in better overall operations. These types of operations provide excellent opportunities for training for managers. The jewelry department manager at Macy's is very well trained in jewelry because that's all they focus on, right? That's their department. They're able to delegate responsibility accordingly based off of their experience earlier in their careers. So typically what happens with management, right? Or with anyone. You start out working in Macy's as a salesperson in the jewelry department. Your manager sees your great job that you're doing and says, hey, I'd like to give you some more responsibility. You perform well at those additional responsibilities. They say, let's get you into a management and training program. You eventually make it to a lead associate. Then you go from a lead associate to a supervisor, and then ultimately to a department manager. Based off of decentralization, Management can identify key skills to help you advance in your career early on. That's one of the key advantages, right? Managers of these decentralized operations work very closely with the customers as well, which is fantastic because the customers in most businesses are the ones that drive the business. You don't have customers, you don't have a business. So the customers work closely with the managers to help suggest in operation and product improvements. And it typically leads to better customer relations. Now, of course, there's a couple of disadvantages with a decentralized operation. One is that decisions made by one manager might negatively affect the profits of the company. Okay, for example, the jewelry department manager at Macy's might make a bad decision. They might say, oh, let's bring in this line of watches that I like. Well, just because you like them doesn't mean they're going to sell very well. Okay? So the manager brings in these line of watches that they like and they don't sell. Okay, that's going to hurt the company's profits based off of that decision. So that's one disadvantage. Another one is that decentralized operations of the asset and expenses might be duplicated across divisions. What does that mean? So if I'm the jewelry department manager at Macy's, and I also have a manager that manages the men's department, a manager that manages the women's department, we might all be doing the same things. And that's duplication. That's what duplication means. We're all doing the same things across different departments. By duplicating, it increases the expenses for each division. So, in other words, I might have a sales associate in the women's department that might be excellent in the jewelry department, but I don't know that. I don't know that because I'm duplicating the operation. So that's a disadvantage of decentralized operations, is that you have multiple managers, but they're not all talking to each other. This is just a nice graphic representation of everything that we just talked about, the advantages and disadvantages of decentralized operations. Okay. In decentralized operations, accounting assists the managers in evaluating and controlling their areas of responsibility. We call these responsibility centers. In other words, the accounting department assists those department managers in creating a budget, managing their costs, controlling their revenues, managing their assets. The accounting department helps those department managers in those responsibilities. Responsibility accounting is a process of measuring and reporting the operating data by a responsibility center. I want you to think of a responsibility center as being a department. A responsibility center is a department. These responsibilities include cost center, profit center, investment center. The department needs to manage their costs. The department needs to manage their profits. The department needs to manage their investments. So these centers are the departments. Each center, which is a department, has a cost, has a profit, has an investment. And the managers are responsible for overseeing those components. A cost center manager has a responsibility of controlling those costs. The cost center manager does not make decisions concerning sales or fixed asset investments within that center. Cost centers may vary in size from a small department to an entire manufacturing plant. Cost centers may exist within other cost centers. So here's an example of this. Earlier, I gave the example of UDC. UDC is composed of several different colleges. Our program belongs to the Department of Accounting within the community college. The university is comprised of engineering, business, arts and sciences, and there's a couple of other ones, as you know. Within the College of Business, we have a couple of different departments. We have marketing, accounting, and management. And the department level, in this course especially, is the Department of Accounting. This kind of just shows you a breakdown of these various cost centers. The Department of Accounting is a cost center. That cost center belongs to a larger cost center, which is the College of Business, or in our case, Division of Business, which belongs to a larger cost center, which is the university. So responsibility accounting for the cost centers focus on controlling and reporting of costs. Budget performance reports budget and actual cost normally prepared for each cost center. In other words, I am responsible for managing the accounting program here at the UDC's community college. So because I have that responsibility, I am responsible for the budget for my program. I am also responsible for reporting the costs of my program. Those get reported to the Division of Business that later get reported to the university. So that's the way to think about it. So this is kind of a nice visual representation of the reporting structure for a budget within each cost center. As we can see, the structure of the business, we have a vice president, and we have a plant manager, and we have a supervisor. This is what we call the organizational chart. Okay? And within this organizational chart, we have each level. The supervisor is responsible for the budget within their department. Okay, that's this lowest level here, where it says Plant A at the bottom for supervisor. That supervisor reports their budget to the plant manager. The plant manager is responsible for 3 different departments within the plant. That plant manager reports their budget up to the vice president of the entire company, who's responsible for 2 different plants. This just kind of shows you how things roll up from the lowest level, which is the department, to the plant, to the company. And you can, as you can see, the flow of the budget. We at the bottom level, we have the department within Plant A. The department has a budget, reports that budget on the Department 1 budget line to the plant manager for Plant A. That plant manager is responsible for all 3 departments within the plant. They have a budget for each department. All of those get totaled, and as you can see, that total for all 3 departments show up for Plant A under the budget for the entire company. The entire company has 2 different plants. So this kind of shows you how everything rolls up. Yep. What is a profit center? A profit center is a profit center manager is responsible for making decisions that affect revenues and costs and thus profits. As you know, revenue minus cost equals profit. Think about the income statement. Income statement, you have revenue, which is your sales, minus your cost of goods sold, equals your gross profit, minus your expenses, equals your net income, which is your profit, right? And so think of the profit center manager as being responsible for the management of the income statement. It's a nice way of thinking about it. But the nice thing is that manager, they are not responsible for the balance sheet. They don't need to make balance sheet decisions. In other words, they're not worried about the building. The department or the person that's managing the income statement, they're not worried about what's going on with the building. They're worried about their department and managing their income statement for their department. So that is a profit center manager. The focus, again, is on the income statement, revenues, expenses, ultimately profit. So the way to think about profit center manager, the profit center manager is responsible for managing the income statement. Revenue minus cost of goods sold equals gross profit minus all of your expenses equals net income, which is your profit. There are a couple of things that are controllable within the environment. Things that are in our control, we call those controllable. Things that are in our control, we call those controllable. Things that are in our control are things that we can manage. I can control my revenue that I earn. I can control my expenses that I incur. I can reduce my own expenses by tightly managing my expenses. I can increase my revenue by tightly managing my revenue. That's kind of what this tells us, right? Okay, so we talked about profit centers, we talked about cost centers. Now let's talk about this from a perspective of a service department. This is different from manufacturing. Service is different from manufacturing. Manufacturing, as you know, as we've talked about through this entire course, is made up of a few things: direct labor, direct materials, and factory overhead. We've been talking about that for a long time now, right? But now let's talk about the other side of the business, which is service department. Service does not deal with direct materials, direct labor, factory overhead. It is comprised of factory overhead, but we'll talk a little bit more about that. On the service side of the business, we're concerned about things like research and development, legal, that's your corporate attorney, right? Telecommunications, how departments talk to each other. Information and computer systems, facilities management, purchasing, advertising, payroll accounting, transportation, human resources. All of these are services for the business, right? They mostly are comprised of costs, right? They all have direct costs associated with them, like operating expenses, salaries, utility expenses. All of these typically are involved in a centralized operation within a service department. Service department charges are that we call these indirect expenses to a profit center, because they typically go against the profit for that department. For example, I have a telephone in my jewelry department at Macy's. My telephone expense goes against my profit center for my jewelry department, because that telephone expense is within my department. Okay? So similar to these expenses that would be incurred by the profit center, purchase the services from the outside the company. My department in Macy's, my jewelry department, has associated expenses with that department. I'm responsible for the salaries of my salespeople. I'm responsible for the utilities in my department. I'm responsible for what other expenses in my department. So those go against my profit center, right? They get deducted from my profit in my department. Profit center manager has control over the service department expenses if the manager is free to choose how the service is used. In other words, if I'm the manager of the jewelry department at Macy's, I can have control over my salespeople in my department. I might not have control over the lighting in the store. That's out of my control. Okay? If it's out of my control, then the centralized operation takes that expense. My department doesn't take the expense for the lighting. That's the whole store. So that expense, that utility expense, gets applied to the centralized operation, not to the department. Does it make sense? Yes, hopefully? Okay.
Yeah.
Wonderful. Thank you. Okay. Oh, I love this example. This is a fun example. Okay. Instead of it being called this entertainment company, let's say this is Disney. Disney. Okay, everyone knows Disney. Walt Disney Company is a diversified entertainment company, and it has two primary divisions. One is the theme park division. We have theme parks in Florida, in California, and around the world, right? The second thing Disney has is the movie production business, movie production division. In that division, we create wonderful films. So two divisions for Disney, theme park and movies. Revenues and direct operating expenses for the two divisions. Revenue for the theme park division is $6 million for the year. And our operating expenses for the theme parks are $2.495 million for the year. On the movie production division for Disney, we have $2.5 million in revenue and $405,000 in expenses. The operating expenses consist of direct expenses such as wages and salaries for the division employees. Okay. Did I skip a slide? No. Okay. Sorry. Disney's service departments and expenses were purchasing, payroll, accounting, and legal. $905,000 for the year. Now, I can apply these expenses that we incurred for each division if I know the allocation base. So just like we talked about with the activity-based costing in earlier chapters, we use a very similar approach to applying these expenses. So we have activity-based for each service department used to charge each department expenses to the theme park and movie divisions. For Disney, we have the following departments. We have purchasing, payroll, and legal. The activity base for purchasing is the number of purchase requisitions. The activity base for accounting is the number of payroll checks. And the activity base for legal is the number of billed hours for our legal team. Okay, so looking at Disney's two divisions, the theme park division and the movie production division. For the theme park, we had 25,000 purchase requisitions, we issued 12,000 payroll checks, and we had 100 hours billed for our legal department. For the movie production department, we have 15,000 purchase requisitions, 3,000 payroll checks issued, and 900 legal hours billed. What we do is we total the each component, so 40,000 purchase requisitions total, 15,000 payroll checks total, and 1,000 legal hours. Now we have to figure out what is the rate. The rate, again, very, very similar to what we learned about in earlier chapters, right? The rate at which the services are used in each division is called the department charge rates. To do that, we take our service department expense divided by the total service department used. So for Disney, for purchasing, we purchased a total of $400,000 worth of stuff. Each and we had a total of 40,000 purchase requisitions. So that comes out to $10 per purchase requisition. You simply take the service department expense, 400,000, divided by the total number of requisitions. That's $10 per purchase requisition. For payroll, we had a total of $255,000 in payroll expense, divided by 15,000 total payroll checks issued. That's a cost of $17 per payroll check. For legal, we had a total of $250,000 billed to us. It was a total of 1,000 billable hours. It's a total of $250 per hour. So once you figure out the service department charge rate, you then take that amount and you multiply that to your service usage. So service usage times the service department charge rate equals your service department charge. Okay, so let's do that. We have theme park division purchasing $250,000. So how we got $250,000? We took our 25,000 purchase requisitions for that department. We multiplied it by the $10 per purchase requisition. Got us to $250,000. For payroll for the theme park, we issued 12,000 payroll checks at $17 per check. It cost us a total of $204,000. For legal department, it was $25,000. How we got that? 100 hours, billable hours, times $250 per hour is $25,000. So we can see how the expenses get allocated to each division. So again, the first thing you do is you figure out what is the total for each item. For total for purchasing, total for payroll, total for legal. The total for each item. Then we need to figure out what is the total per unit. Total per unit, again, we do that. We take the total expense divided by the total used to get the total per unit. Take your total per unit, multiply that times the total used, and that gets you the total cost for each item within each division. Does it make sense? Are there any questions so far?
No, yes, it makes sense.
Right? I'm sure you will see this in the homework. So that is a really good example to use for the homework. Just saying. Okay.
The 23rd, right? Professor, you talking about the 23rd one, right?
That's right. Yep. Talking about the chapter 23 homework.
Did I tell you that? Yes, so you're right. It is on.
Yep,
It is.
it sure is. So I strongly recommend that you look at this example to help you with Chapter 23 homework, for sure. It does help a lot. Okay. So what about reporting? This is really cool. We went over service department charges. Now let's talk about reporting. When a manager is evaluating the performance of a company, we look at the profit center and the cost center. In the profit center, the income from the operations is compared to the budget over time. Remember how before we did when we talked about budgeting, we talked about actual versus estimate? The same type of principle applies here. We in the profit center reporting, we look at the budget compared to the actual, and we look at that over time. It should not be used to compare different cost centers because those are usually different size, different products, different customers. In other words, we should not be comparing one profit center to another. That doesn't work too well because they're different. They're totally different areas within the company. So in other words, if Disney's looking at the theme parks and comparing them to the movie division, that's not going to work out too well because they're two different things. They're two different sizes, different products, and different clients. So because of that, you don't want to, when you look at profit centers, don't compare different profit centers to get to, you don't want to compare different profit centers. You want to just look at each profit center individually and look at the performance over time. So, for example, here we have, again, Disney. We have theme park division and movie production division. And this is the income statement. We have revenues, operating expenses, other expenses, right? And then we have our net income from operations. We can see the breakdown for the theme park and the breakdown for the movie divisions. These are two different profit centers. I'm not going to compare them to each other because they're totally different in terms of size and scale. I'm going to only compare them to each performance year. So this is 2016. I'm looking at Disney's theme parks 2016. I'm going to compare that to 2017. I'm going to compare that to 2018. I'm not going to compare it to the movie division because that doesn't make sense. And I will do the same thing for the movie division. Movie division 2016, movie division 2017, movie division 2018. That gives us a better perspective. Okay, so we talked about the cost center, we talked about the profit center. Now let's talk about the investment center. Investment, when we talk about investment, we're talking about fixed assets. As you remember, fixed assets are property, plant, and equipment. And we are looking at decisions from those perspectives. They typically do not affect costs and revenues from all we take cost and revenue out of the decision making. We only look at the fixed assets, property, plant, and equipment. Investment centers are often used in diversified companies by divisions. In these cases, divisional managers have the authority, chief operating officer, president of the company, blah, blah, blah. Okay, a way of thinking about it is with Disney. We have our theme parks and we have our movie division. Okay. The theme park fixed assets are the rides. Okay, that's your roller coasters, your merry-go-rounds, your whatevers, right? Your flat rides, so forth and so on. That's your property, plant, and equipment. In the movie division, it's the cameras, it's the stages, it's that's your property, plant, and equipment. Your sound stages, so forth and so on. Each department manager of the theme parks, manager of the movies, they can make decisions for their individual property, plant, and equipment. That's what this tells us. Because investment center managers have those responsibilities for revenues and expenses, the income from operations is a part of the investment center reporting. In other words, I need to know how much revenue and expenses each department incurred in order for me to make good investment decisions. I can't purchase a roller coaster for the theme park if I don't know how much the theme park made in revenue and had in expenses, right? In addition, because those managers have those responsibilities for assets, the property, plant, and equipment, the following two measures must be used. There are two calculations we need to know for the investment. We have to know what we call ROI, return on investment, the rate of ROI. And we also need to know the residual income. Another example, this is our a company we had before in previous examples from other chapters. This is DataLink. This company leases equipment to customers for their routers and modems and things like that, right? This company has three divisions: Northern, Central, and Southern. Revenue, expenses, other income, other expenses, net income. When we look at ROI, we're looking at this information. So what is ROI, return on investment? With any investment, we expect to get a return on that investment. In other words, eventually that investment will yield us a profit in the future. That's what a return is. So looking at ROI, we need to get an idea of if this ratio is useful or not. It will tell me if I should make that investment or not. So how do I calculate ROI, or return on investment? I take income from operations and I divide that by invested assets. Income from operations divided by invested assets. So income from operations for the Northern Division for DataLink, $70,000, and we don't know what the invested assets are. Well, you take income from operations divided by invested assets. The rate of return from the investment is very useful because it tells us if we should consider an investment or not. The higher the ROI, the more likely it is to generate income for the business. So higher ROI, the better, right? So let's look at our company. We have, now here's the data that we have. Northern Division, 350,000 invested assets. Central, 700,000. Southern, 500,000. Looking back here at our earlier information, Northern Division, 70,000. Income from operations. Northern Division invested assets, 350. So what we would do is we would take our calculator and go 70,000 divided by 350,000 gets us to 0.2, which is 20%. So again, we take income from operations divided by invested assets. 70,000 divided by 350,000 is 0.2 times 100 is 20%. That's pretty high. Okay, so that's good. I would make an investment in the Northern Division based off of this high ROI, return on the investment. And you would make that same calculation for the other divisions within the company. So 20% for the Northern Division, 12% for Central, 15% for Southern. Does it make sense so far? Any questions on ROI, return on investment? You good? Okay. What about further analyzing ROI? To analyze ROI across divisions, we use a relatively complex formula called the Dupont Formula. The Dupont Formula was created in the early 1900s by the Dupont Paint Company, or Dupont Chemical Company, a long time ago, yeah? They have been around for a long time. This company used their own formula to determine whether their investments were good or not. The formula looks at two factors. We look at profit margin and we look at investment turnover. Profit margin, as you know, is the ratio from income from operations to sales. We learned about profit margin a long time ago. We also learned about investment turnover some time ago as well. That's the ratio of sales to invested assets. So let's look at this ROI. So ROI, profit margin times investment turnover. How do we get profit margin? We take income from operations divided by sales. How do we get investment turnover? We take sales divided by invested assets. Think of your order of operations. There's invisible brackets here. Invisible brackets for each one. You do division before you do multiplication. So you would take care of this one and this one before you multiply the two together. Please, it's very, very important that you remember your order of operations when calculating this formula. Remember, there's invisible brackets. You divide before you multiply. Divide this by this, then divide this by this, and then you multiply those two numbers together. Make sense? Yes, hopefully. Okay, good. Looking further at the Dupont formula. It's useful for divisions because it looks at the profit margin and investment turnover to better understand the relationships between each division. Profit margin tells us the profitability of those centers for each division. The investment turnover tells us how quickly in converting sales dollars into cash for investment. Okay, so our company has those three divisions, Northern, Central, Southern. The ROI using the Dupont formula, first we do income from operations divided by sales, then we do sales divided by invested assets. Here's how it works. For our Northern Division, we got $70,000 income from operations. Our sales were $560,000. So I do that first, and that gets me 12.5%. Or it'll really be 0.125. But you express that as a percentage, which means you multiply that by 100 to get to 12.5%. Then we take our sales divided by invested assets, sales 560,000 divided by 350,000 invested assets to get 1.6. 12.5% times 1.6 equals 20%. You realize now that the Dupont formula for ROI yields 20%, which is the same as the 20% we got from using the ROI formula, which was income from operations divided by invested assets. So it's just kind of like another way to show you how we would compute ROI using Dupont formula or by using the ROI formula. To increase the rate of return on the investment, the profit margin and investment turnover for a division may be analyzed. So in other words, I can look at these individually, these components individually, to analyze each department, each division. So let's look at our Northern Division again. We assume that we can increase our revenue by $56,000 through increasing operating expenses such as advertising to $385,000. In other words, if I advertise more, that will result in more sales. That's the idea anyway. So great. So with this change, we would increase our income from operations from $70,000 to $77,000. So here's how it's computed: $560,000 plus an additional $56,000 by increasing our advertising expense gets us to $616,000. Our new advertising expense is $385,000. Revenue minus your operating expense equals income from operations before service department charges, $231,000. Minus service department charges, $154,000, equals income from operations, $77,000. So let's compute our ROI using the Dupont formula. We take income from operations, $77,000, divided by our revenue, $616,000, gets us to 12.5%. Then we take our revenue, $616,000, divided by our our total invested assets of $350,000, equals 1.76%, which yields us a total ROI of 22%, which is a full 2% higher than our old ROI. So the question becomes, do I increase my advertising budget to yield additional revenue? And of course, the answer is going to be yes, because I can yield an additional 2% on that investment. Which is what this basically says. So the ROI is useful for deciding with the investment or the expanded operations. So if I make that investment, I can increase the total return on my investment by 2%. If I increase my advertising expense, which will ultimately increase my revenue. A disadvantage of doing this is that it may lead to divisional managers rejecting a new investment because it could be that would otherwise be profitable for the company. So, in other words, a manager might just be like, 2%, it's not that big. I might not do it, but the whole company might actually profit from that additional 2%. So that's one disadvantage of doing this. So further looking at this, so now we assume the following rates for the Northern Division. The current rate is 20% ROI. Minimum acceptable return for ROI is 10%. We expect to get 14% ROI on a new project. if the new project overall return will decrease from 20% due to averaging, the manager might decide to reject this new project. But here's the interesting thing. Our investors said that we have a minimum ROI of 10%. Our current ROI is 20%. If I do this new project, the new project will yield me 14%. A manager might say, hey, you know what, I'm not going to do this because my current ROI is 20%. This might drop me to 14%. I don't want to lose. I'm not going to do it. But the reality is the overall company might benefit because this new investment is still 4% higher than the minimum acceptable rate. So the decision becomes, do you do this investment or not? And if for me, I would, because it's still above the minimum acceptable rate. Now we talked about ROI, let's talk about residual income. As you know, residual income is the difference between one additional unit of output. Residual. Residual income is the excess of income from operations over minimum acceptable income from operations. In other words, looking at my earlier example, my residual income here is 4%. 4% because 14% is higher than 10. The difference here is 4%. 14% minus 10% is 4. 4% would be my residual income in that example. To figure out residual income, you take your income from operations minus your acceptable return to get residual. Income from operations, 14%, minus minimum acceptable, 10%, that's 4%, residual income. Looking at it from a dollar perspective, income from operations, 70%. Minimum acceptable income is $35,000. How'd you get $35,000? We took our income from operations for that division times 10%. Why 10%? 10% is the minimum acceptable return. Minimum ROI is 10%. 350,000 times 10% is 35,000, which means we would have a residual income of 35,000. How we got there? 70,000 minus 35,000 equals 35,000. Major advantage of calculating residual income is that the performance measure considers both the minimum acceptable return, invested assets, and the income from operations for each division. So looking at our earlier example, if we assume the following rates for the Northern Division, current rate's 20%, minimum acceptable is 10, expected returns 14. Manager evaluates the projects using the ROI, might decide to reject this project because it's less than the current 20%. However, the 14% is still above the minimum acceptable return of 10%. Or they might decide to do it because the residual income is 4% higher. Now let's look at another concept that is used in accounting that is non-monetarily based. This is called a non-financial performance measure. Non-financial performance measure. It's called a balanced scorecard. A balanced scorecard evaluates the business's performance by looking at customer service, innovation and learning, internal control processes. Customer service, what do I mean by that? On a balanced scorecard, my customer service is based off of number of repeat customers, number of returns, a number of complaints. That data helps to comprise my customer performance, my customer service. Innovation and learning comes from the number of employees that are trained, the number of trainings I offer my employees, the amount I have in research and development. That's innovation and learning. Then we have internal processes. These are the actual processes and how many steps each process takes, things like that. We look at all of these things together in addition to financial performance, so customer service, innovation, learning, internal processes, we take those three things on the balanced scorecard in addition to financial performance to look at the total company performance. We call that a balanced scorecard. The balanced scorecard helps managers to identify the non-financial drivers, in which case helps the business to continue to improve. So in other words, I'm going to look at my overall customer service performance to help the business to make better decisions in order to get more customers, which in turn relates to more sales. And these are just some factors that we look at in each area on the balanced scorecard. So again, number of new products, number of patents, this innovation and learning, number of trained employees, training hours, ethics violations, employee turnover. Customer service. Go ahead. Well, I'm sorry, what was that?
There are a lot of businesses that are missing this concept right here.
I'm sorry, one more time.
Can you hear me?
I can't hear you. It's a little loud in the background, I think.
All right, second, go ahead. Give me 1 second.
Okay, so in other words, like these items, these elements, help the company overall to determine its overall performance. That's what we call a balanced scorecard. That's why we look at, especially like if you look at the customer service, number of repeat customers, brand recognition, time to deliver to the customer satisfaction, number of sales returns, customer complaints. All of those things together make up the number or percentage for customer service, and then you do the same thing for these other three items. Helps us give a better overall picture of the company's performance. That's a balanced scorecard. Okay, let's talk about transfer pricing. Sometimes divisions will transfer product from one division to the other, especially if they sell the same stuff. So looking at our earlier example with that data company, that data company leases equipment to their customers, okay? In the Northern Division, the company might have a bunch of extra units available that they don't need. But the Southern Division needs those, okay? So what the Northern Division will do is they'll transfer that inventory to the Southern Division. Well, there's a cost associated with doing that, right? And because of that, we look at transfer pricing. So there's three approaches to transfer pricing. There's the market approach, negotiated price approach, and the cost approach. With transfer pricing, the objective is setting up a transfer price to motivate managers to behave in a manner of which will increase the overall company income. In other words, if the Northern Division has a bunch of extra inventory, they need to and the Southern Division needs that inventory, we'll transfer it, but we want to do it in such a way where the company benefits, where the overall income increases. The transfer price that we can set will allow the variable price per unit as high as the market price, but is oftentimes negotiated between the two divisions. The Northern Division manager and the Southern Division manager will talk to each other and say, hey, I have this inventory. I know you need this inventory. I'll transfer it to you at a negotiated price. And that will typically yield in higher income for the whole company. We call that transfer pricing. So in this example, the Eastern Division and Western Division are transferring inventory. This is in this first part. This is no transfers. This just kind of shows you what each division has, Eastern and Western, right, and the total company. Using the market price approach, transfer pricing is based off of the product or service transferred that can be sold to outside buyers. In other words, how much is the outside willing to pay for this inventory, and I'll transfer it to you at that price. Oftentimes, the market price is usually the highest. But using a market price approach, the transfer price is the market price. That's why transfer price equals market price for the market price approach. This assumes that materials are currently purchased at a certain price from outside suppliers. If materials are purchased from outside suppliers at a particular price, we call that market price. Now let's look at this example. This company has two divisions, Eastern and Western divisions. This company produces snack food, like small bags of chips or whatever, right? So the Western Division currently purchases price from an outside supplier at $20 per unit. The Eastern Division produces the same materials. The Eastern Division is operating at full capacity, which is 50,000 units. That's the most that they can produce and sell at the same time. And it sells its product to either the Western Division or outside buyers. A transfer price of $20 per unit, which is the market price, has no effect on the Eastern Division's income or total company income, because it's the same price as it would sell to an outside buyer. The Eastern Division buys from the Western Division at $20 per unit. The Eastern Division can also sell to outside buyers for the same $20 per unit. So there is no net change when it comes to market pricing approach. But there is a net change if you use a negotiated price approach. So again, in this company, we have the Eastern Division and a Western Division. They make snacks, okay? The Western Division sells to the Eastern Division, and the Eastern Division needs more, the Eastern Division sells to the Western Division. The Western Division is currently purchasing at the market price, which is $20 per unit. But the two managers, the Eastern Division and Western Division managers, could get together and negotiate a price between the two divisions. Just remember that the current market price is $20 per unit. If the two divisions get together and negotiate a price, they can negotiate a fixed price. Okay. Currently, the market price is $20. We call that the variable cost. The market price, $20. The variable cost that covers the fixed and the fixed and variable expenses are $10 per unit. So $10 per unit can be the new cost per unit if it's negotiated between the two managers. Using the negotiated price approach, this allows the two managers to agree to that transfer pricing. The only constraint here is that the negotiated price needs to be below the market price. In this case, it is $10. There's also a transfer price that's involved. So let's assume that instead the capacity of 50,000 units is now 70,000 units. In addition, let's assume that the Eastern Division can continue to sell only 50,000. That means that the additional 20,000 needs to be purchased from outside buyers. Transfer price of less than $20 would encourage the managers between the Eastern and Western Division because it's below market price. But because there is a change in capacity, that means that that additional 20,000 units needs to be at market price. So we know that the capacity of 50,000 units can be transferred. 50,000 units at 20, 20,000 units at 15, 20,000 units at 40. These are our sales. Looking at the transfers. Remember, the capacity went from 50,000 to 70,000. 70,000 units at $10 per unit is 700,000. 20,000 I cannot transfer. 20,000 I cannot transfer. That needs to be purchased at the market price. In this case, it's $25 per unit. Why $25 per unit? Because the difference between market and non-market is 5. So 15. The 25 represents that difference between the Eastern and Western Division. So looking at the negotiated price, market price is $20 per unit. The transfer price is less than the market price, and the variable cost per unit is $10 per unit. So as we could see, the negotiated price approach is the most logical because it is below the market rate. The third approach that we talked about is the cost-price approach. The cost approach is the cost per unit, total cost per unit. The total cost per unit is, as you know, includes direct materials, direct labor, factory overhead. Variable cost per unit included the fixed factory overhead rate. Actual cost for standard versus budgeted is applied in this process. And so the cost price approach is most often used when the responsibility centers in organized cost centers. In other words, that cost price approach is more like direct cost approach is the way I want you to think about that. Direct cost approach. Fixed cost, variable cost, factory overhead, or direct materials, direct labor, factory overhead. That's the cost price approach. So out of the three, you might ask, which is the most effective? It depends. It depends on what the market price is, because that will ultimately tell you which of those three are most effective. Is it market price, is it negotiated price, or is it cost price? Cost price, again, is your direct materials, direct labor, factory overhead. Your market price is whatever outside people are willing to pay. Your negotiated price is negotiated between the two division managers. So which of the three is the lowest is going to be the best approach. And that's going to depend on the market price. And that is the end of chapter 23. Are there any questions at this point for chapter 23 before we jump into 24? And don't worry, chapter 24 is quite a bit shorter, so it should only take us about 25 minutes or so to get through it. Any questions? Are we okay?
We're good.
Okay, sounds good. I'll stop the recording for this chapter and we'll begin the next recording.